switch it off for a while and keep. Yeah, after that we'll on. Okay, right. So, guys, very good afternoon to all of you. Let's start the class then. So today, guys, the focus will be on what you can say. Yeah. So guys, today the focus will be on what you can say consolidated ratio, right? Let's try to do, guys. I think so far in class, I have done, I think, one consolidated ratio. Let's try to do another 2 to 3 in today's class. So I think this would be today's final class, guys, when it comes to FR, right? Okay, so guys, regardless, could you take out your exam kit and please go to a question that says over here. Now, I know that I did start a question half, but I didn't evaluate. We'll do that also, right? So we'll start off with a fresh question, guys. Could you please go to this question that says room corporation, VROOM. In your exam kit, one before the last question. Okay, one before the last question, right? Go to that part, guys, over there, one before the last question. And also, guys, remember, I hope you all attempted the pre-mock exam, right? Yesterday, I finished off the recording for the pre-mock. So it should be available to you with the discussion. If you haven't done that, please do that, guys. It's a very relatively easy paper. And questions similar to that can come in the exam. Okay, so please do try that paper. Okay. Right. So, guys, take your exam kit and please search for this question, guys, over here. Room corporation. Yes, most probably this will be the final because I'm having a small family commitment. So I don't think I'll be able to make it to class in the next few days. That's the reason why I took the class today, because tomorrow I'm unable to, right? That's the reason. Okay, so guys, can all of you guys go to this question over here, 447, room corporation, right? A latest past paper question, right? Go to that part, guys, quickly, right? Room corporation, 447. Okay. Right, so guys, when you're doing on the laptop, guys, please take out the Word software because in your exam, it will be a blank space, right? So in the pre-mock, I'm doing it on the platform itself. So you see that it's a blank space over there. Right, okay. Now, guys, look at the question, what they're asking. Right. Right, so let me guys first write here and keep then. Okay. So guys, put the heading then, Rome Corporation. Okay. Right. 447. Okay. Requirement A. Okay. Requirement A is they're asking for you calculate the goodwill. Okay, so first question, guys, what they're asking is to calculate goodwill, right? Can you guys quickly write down the goodwill equation, right? Goodwill is equal to, right, investment slash consideration, okay, right, plus fair value of NCI, okay, minus net assets, right, at acquisition, which is working number 2. And this will give you goodwill. So normally, guys, for net assets at acquisition, we have to open a separate working. You understand? Normally, when we do the SOFP, this answer is readily available. Okay. Whereas, guys, on the other hand, what you can say is that, right? If you are doing a ratio question or maybe a consolidated P&L, then this answer is not readily available. We have to calculate it. So to calculate it, one, guys, can you separately now put down over there, right? Working, right? Right. And guys, can you mark it over there and show it to me as net assets at acquisition date? Done. Okay, net assets at acquisition date. Today, guys, full class, we will be doing ratios only because I have done accounting standards, right? Financial statements, we have done quite a lot. Okay, in the pre-mock recording also, guys, there is a consolidated P&L, right? So you can just watch that as well. Okay. Right. Now, guys, first of all, I will give you all 5 minutes time. Once you are done with the equation, I'll give you 5 minutes time. Okay. From this paragraph, whatever that you can take, can you guys start marking guys over there faster? Okay. So Amjad, what you should do is like this. Now you can just type it this way. Now yeah, you just type in Google pre-mock exams, right? And it will take you to the let me show that to you. I'll show you where you can find it. Okay. Right. So guys, the others, can you read the first paragraph? Don't take that long. 3 to 4 minutes. Can you quickly mark whatever that you need? Okay. Please mark guys over there whatever that you need from this question. Okay. So guys, have you all done with the first part? Shall I mark the answers, whatever that's relevant? Okay, now guys, see. On 1st of January 2003, Rome acquired 80% of Sleek's 100 million share capital. Guys, now note that one. 100 million share capital is something that I need for my net assets at the acquisition date. Guys, now listen. Now, normally net assets at acquisition date, there are a few constant things in exams. What are the things? Share capital, okay, retained earnings, and also, guys, fair value adjustments. These are the things. So now they have said the company has 100 million share capital. No, so this will come, guys, over here as share capital as net assets at the acquisition date. Okay, are we guys all okay with this one? Right, then what happened? Sleek Corporation is a company that specializes in electric vehicles. What are we? We are a company who is normally selling vehicles. These people are electric vehicles. Okay, right. Room Corporation paid cash 650. Guys, when you pay cash, it's considered as what? Investment, right? Consideration, the amount that you pay to buy your subsidiary. So guys, let's mark it then and show guys over here, right? Investment in this one. So I'll write it down. Cash investment. How much guys we have invested in that one? 650 million we have invested. Okay. Then guys, next one, going further, right? and will pay a further cash of 300 million in January 2006. This is after 3 years. If Sleek meets a certain performance target. Guys, now don't mix these two up. This is not deferred consideration. Deferred consideration means what? We will make the payment in the future regardless, right? If I tell in 3 years I'm going to pay you this much, I'm going to pay you this much. There is no strings attached. But over here, guys, what's going to happen? They will pay that much if they meet a certain target. This is what we call contingent consideration. Contingent consideration means only if you meet a specific target, you're going to pay. So they're going to pay in 3 years, 300 million. On 1st of January, on 1st of January means what, guys? The day that we are buying the company, the fair value of the 300 million consideration due to be paid was 210 million. And on 31st of December 2003, it was 160 million. Guys, now see what happened. You're planning to pay 300 million in 3 years' time. Yeah, very good. It's a contingent consideration. Good. Okay. So we are planning to pay, guys, 300 million in 3 years' time. At the date of acquisition, the fair value is 210. At the end of the year, the fair value is 160. Now, these are points that you should use for evaluation. Okay, once again, guys, in 3 years' time, how much we are going to pay? 300 million. But the value of that at the date of acquisition on January 2003 is 210 million, it seems. But that went down by 50,000 at the end of the current year. So think of these. So therefore, guys, under investment, I should write now, start copying, guys, with me, contingent consideration. Okay, right. Now, guys, there are three values now, 300 million, 210 million, 160 million. I should, guys, mark here 210 million. You should mark the value of the consideration at the acquisition date, which is 200 million. Sorry, 210 million actually, right? So you have to mark that one. Okay, are we guys all okay with that one? So there only you have to mark. Okay, guys, apart from that, I do not see any other number that I need for my calculation for goodwill, right? There is no other number that we have to take. Okay, right. Then guys, here they have given some numbers. I don't think this will impact the goodwill. Okay, right. Guys, now can you do me a small work? Okay, read number 1 and 2. Start marking the numbers and get me the goodwill faster. Okay, please read Roman number 1 and 2. There are some more numbers that we need. Take them and finish off the goodwill and show it to me, guys, faster. Please finish off the goodwill and show it to me. Everything is provided, guys. Only NCI value you have to calculate. Right? Only NCI value we have to calculate. Sure, Ishma, 1 minute. I'll check. No, that's not the value of the NCI. Value of the net assets, let me check and see. Okay. Let's check on those. Right, okay. So guys, the others now who are doing the question, little bit check and see guys how is things going for you. Okay, first one. At acquisition, the retained losses were 80 million. Because normally when we buy a subsidiary, they always have retained earning, profit. But these people have a retained loss. So guys, here you should mark it and show as minus 80. Make sure guys you have marked it over there. Minus 80 for retained earnings. Sleek also had unrecognized intangible asset at a fair value of 250 million. That means like this, guys. Okay. Sleek has an internal intangible asset. Okay. Sleek company has an internal intangible asset. Now, internal intangible asset means Sleek can't recognize now. According to IAS 38, internally generated intangible assets we can't recognize. That's why they are telling unrecognized. But now room, we are buying Sleek. No, when we buy Sleek, for us this becomes what? Purchased intangible asset. So we can recognize this. So there is a fair value of an intangible asset that is 250 million. So guys, let me mark that over here. Done. Okay. Right. Then guys, what's going to happen over there? The non-controlling interest is measured at fair value. The share price of Sleek is 6.8. Guys, listen, how to value your NCI. Now look at the working that I'm going to do. Now they're telling it 6.8 per share. Guys, NCI in our company is how much percentage? 20%. 20% of how many shares? 100 million shares. Okay. How is it 100 million shares, guys, over here? Now, can you see this part, guys? Here, see? Right. They have a 100 million share capital now, guys. Right. So therefore, out of 100 million shares, 20 million is our one, or 20% is our one. And this will help you to guys identify what's going to be the fair value. Yeah. What I mentioned was like this. Now see, Sleek has an unrecognized intangible asset. What does it mean? It's an internally generated intangible asset. Right. Unrecognized. Now, usually according to the standard, they say if there is an intangible asset that you generate internally, you can't recognize. So Sleek cannot recognize because it's an internal one for him. But now think this in the parent's point of view, Room. Now Room is buying Sleek, no? That means for Room, this becomes a what asset? Purchased intangible asset because he's paying for this also. That's why we can recognize this and show when we calculate goodwill, right? For the subsidiary, it's an internal one. He can't mark it in his financial statements because the standard doesn't allow. But for parent, he's paying, is buying Sleek. That means it becomes a purchased intangible asset. So we can recognize this and show. This is what I explained. Yeah, so that has to be the correct answer. Rimas, earlier also you sent me the correct answer. I didn't check on that one. Yeah. So therefore, guys, it's going to be 136 million, it seems. That's it now, guys. Do we have any other answer over here? Then, guys, on the other hand, yeah, that's it now, guys. That's the only number I think that we should take. Okay, now, guys, first, can you work this out for me, guys, faster? Right. Now, first work this out. Okay. So therefore, guys, the net assets at the acquisition date, we are getting the answer as, guys, how much over here total? 350 minus 80, 270. I think someone sent me 270 as the answer. Yes, correct. 210 is the value at the acquisition date. Okay, 300 million is future value. I think Amjad, you sent me the answer. That answer was correct. Okay, now guys, take the 270 and guys, now mark it over here faster. Minus 270. Right. Now, guys, can you please get me the answer for goodwill? 650 plus 210 plus 136 minus 270. Yeah. Very good, guys. Goodwill of the company is 726 million. That should be the answer. Good. 726. So, guys, first thing, you total the net assets and take it over here. Then add the investment at the fair value minus from net assets. Then, guys, you will get the other answer over there as 270 million. This should be your answer. Okay. Right. Now, guys, are we all okay with this part? This is how to calculate goodwill. Right. Now, guys, look at the next question, what they're asking. Right. Using the pre-formatted table provided. Now, since this is the exam kit question, the table is not there, but maybe in your real exam, a table might appear. Like ratio, room group, room individual, like that a table will appear. Right. They are asking you to calculate the ratio for 31st of December 2003 and 2002 for the group and individual statement respectively. Guys, again, see, calculate. No need to adjust anything. No need to add or subtract anything. Just what you should do, you have to just what you can say, guys, just copy the numbers and get me the ratios. Okay, now guys, put the next part over there, part B. Yes, Sandra, it has to be a past year, but I can't remember which year that is. Okay, right now, guys, mark that one over there. Right now, requirement B. Okay, let's now calculate the ratio. So, guys, I will draw a small table over here. Okay, right, as ratio, right? Right, then, guys, formula. Then we have what are the things they're asking, guys? Room group. Okay. Right. And also, guys, on the other hand, they are also asking room corporation. Both they are asking. Okay. So, guys, now notice this. Room group means what? Consolidated financial statements. Room corporation means individual financial statements. So, technically, you're comparing an individual financial statement with a consolidated financial statement, the performance. No need to draw the table in the exam. They will be giving you what you can say, a pre-formatted table. That means the table will appear. You just have to keep on typing only. Okay, they won't ask you to draw the table. Okay, now guys, let's start marking then. First, they want gross profit ratio. Okay. Okay, then guys, on the other hand, they want operating profit ratio. Right. Then we also need right ROCE. So guys, I'm writing the formula because it's more easier for me when I have the formula. Gross profit divided by revenue into 100. Okay. Right. Then guys, on the other hand, when it comes to operating profit, guys, what's the equation? Right. Operating profit divided by revenue into 100. Right. Then guys, on the other hand, ROCE, operating profit divided by revenue, not revenue, divided by capital employed into 100. Right. So these are the equations, guys, that we have. Okay. Right. So guys, copy down the equations, right? And now I'm trying to show you guys numbers as much as possible. Yeah, this is the maximum. Okay, can you guys now quickly calculate the ratios and show it to me, guys? I'll give you, no need to mention the formula, right? But I prefer to normally do it because it's easier for me, right? But it's not compulsory. Profit before interest and tax. Right. Now, guys, on the net profit means profit after interest, and after taxes. Profit for the year, profit after taxes. Okay, right now, guys, here I have given you the numbers, right? Now, the thing is, I'm unable to show you all as we'll see, will you? Okay. Right. Guys, can you start calculating for me, guys, these answers quickly? These are maximum, guys. I can zoom. right? Because if not, what happens is some of the numbers get cut. That's why. Okay, so I'll give you 5 minutes. Start calculating for me, guys, all the ratios quickly. Yeah, Daniel, all the answers are correct. Huh? Yeah, Asya, so good. Answers are correct. So, guys, I see most of you all have already finished off your answers, and let's see, you have sent it to me over there. Let's see Basil's answers. Okay. Also, can little bit check on your ROCE only, right? Only that. I think the rest should be okay. Just check on the ROCE only. Yeah, guys, I'll now mark the answers. I feel like all are now doing good. Okay, so guys, first one, I need the gross profit. Gross profit is 2,300 divided by 13,450 into 100. Whereas guys over here, single entity, 2,400 into 12,000 divided by 12,200 into 100. Over here guys, what we have, operating profit, which is going to be right, 730 divided by revenue 13,450 into 100. Over here guys, we have 940 divided by 12,200 into 100. Right. Then guys, again, operating profit 730. Over here guys, operating profit 940. Divide. This one also guys, divide. Capital employed. Here guys, that link capital employed 33,670 into 100. Here guys, it's going to be 31,450 into 100. Right. Okay. Right. Now guys, according to the students who have sent me, the answers are going to be no, you can show, preferably better to show. Okay, right. So guys, the answers are 17.1% over here. Where guys, over here, the answer is going to be 19.7%. Okay. Then guys, over here, the answers are going to be how much? It's going to be 5.5%. And over here, it is 7.7%. Right. Return on capital employed, guys, the answers are 2.2%. And also over here, 3.3%. So these are the answers, guys, what we are getting. 20%. Yeah, you can round it off if you want. No problem. Yeah, it's always preferable to show this one, how you're getting the answers. It's always better. Equation, no problem, but this one better to show. Okay. Okay. It's coming as 3. 1 minute, guys. 98. 940 divided by 31,450 into 100. 2.9. Yeah. So guys, sorry, it's 3%. This has to be 3. Correct. Okay. Guys, now you all read the first paragraph, no? Okay. Now, guys, can you start reading these points? Because now what are they asking in this paper? Analyze the performance of room group and room corporation. Both they're asking you. Okay. Can you guys first take a few minutes time? And now, guys, start reading this one for me faster. These points over here. Then we can now start the evaluation. That's not an issue. That's not a big, this one. Okay.
Recording in progress.
Thing is this, since they are not specific regarding the rounding off, it's not a problem. Okay, because they are not specific about the rounding off, it's not an issue. You can go with whatever that's preferable to you. Okay. Okay, all good guys. Now have you all read all the points? Okay, shall we then start evaluating? Okay, right. Guys, let's start with now. First one was gross profit ratio. No, okay. Can you guys quickly give me a comment about the revenue faster? Give one line comment for me faster. Okay, we'll start off with this one. Okay, so let's start with. Okay, I'll just push this to down table, down page. Okay, right. Can you guys quickly give me now? Put the heading guys over here. Then we'll start. Then right. Put the heading performance. Right. Put the heading performance. Okay. Right. Can you guys first mark it over there for me as this one over there? We have revenue. Okay. Guys, can you comment about these two faster? Revenue. That means can you comment from here to here? Right. What has happened and why? Give me two reasons if possible. Okay. Revenue has increased. Can you tell me why? Two reasons. Okay. Now, guys, revenue has increased. There were two reasons why revenue has increased. Can you guys tell me what is the one reason why the revenue has increased? Yeah, very good, Daniel. Sajri's answers are correct. Okay. Yes, exactly. Okay. Guys, first of all, tell me 2002 is room single entity, one person's answer. This is room consolidated. Consolidated means, guys, whom and whom? Parent and subject. So of course, no guys, there is going to be an increase in revenue, no, because 2002 is single entity performance. 2003 is two people's performance. So with the acquisition, definitely in consolidation, Sleek's revenue is also there. That is one reason why it has increased. What is the other reason, guys, why it has increased? It's over here. What is the other reason why our revenue has gone up? Because of what? Correct. Good. Yeah. What is the other reason, guys, why they are specifically telling you? In plain words, they have said you why the revenue has increased. Yeah, that's the answer. That's correct. Yes. Guys, look at the last point. Room Corporation has launched a range of after-sale services due to lower repairs. These have been very profitable, right? So that new strategy has increased in sales. Okay, so shall you guys start writing down over there? Okay, let's mark this one then. Why the revenue has increased? Okay, guys, now itself we can't touch on this global market thing. Now itself we can't, because you know why, guys? As a decline in global sales, we took a decision to invest in Sleek in relation to the research. Still, it's in the research phase, guys. It's still in the research phase, right? Okay, right. So guys, then let's start marking guys over there then revenue, right? So the reasons guys why revenue has increased. So you can start revenue has increased, right? Over the year, right? Due to, right? The due to the acquisition of Sleek in 2000 X3, right? So guys, I'm getting short points only, right? 2000 X3, and also, right? Right. Room Corporation has launched a range of new services which has boosted revenue. Services which has boosted revenue. Now, right. So we can tell that as the answer. Okay. Right. So guys, now you all are okay with those 2 points now? Okay. But guys, what happened? Now look at the gross profit. Yeah, you can include the increasing percentage, no problem. Okay. But guys, see, if the revenue increases, what should happen to the gross profit, guys? Gross profit should technically increase. But guys, now see over the year what has happened, right? Room Corporation gross profit is 19.7%. But over here, guys, the answer is going to be how much? 17.1%. These are the two answers what we have. Okay, right. So individually, we were having 19.7, but even with the acquisition, guys, what has happened? The answer has gone down to, guys, 17%. Can you guys give a comment about that part quickly? Okay, start commenting on that one if possible. Okay. Yeah, we can tell that as 1 point. Good. Yeah. Yeah, increase in cost of sale. Yes, cost of sale has gone up. Correct. That was a we can tell. Right. Okay. Guys, any specific reasons on why the cost of sale has gone up, guys, over there? What are things that we can tell? No, decline in global sales means the revenue has to fall, no? Okay. That one, the revenue has to fall. Yeah, very good. We can add that as a point, Shafee. That answer is correct. Okay. Right. Now, guys, let's start commenting on the other part over there, right? So, see, right? Though, right, right. The revenue has increased, right? The gross profit has declined over the year, right? Though the revenue has increased, gross profit has declined over the year, right? This could be due to the increase in cost of sales being larger than the increase in revenue, right? This could be because the increase in cost of sale is larger than the, now here, guys, cost of sale actually has increased. So now see here, revenue, guys, from here to here has only gone up by some 1.2 million. But the revenue, guys, but the cost of sale has gone up by 2 million. So the revenue cost of sale going up is a little bit more larger than the revenue going up. Okay. That is one thing that you can tell. Right. Right. Then we can tell potential reasons could be, right? Potential reasons could be, okay. Now, guys, one student has pointed out for me is because of this research, right? Now, here, guys, now you can see, according to point number 4, telling that our company, Sleek Corporation, the subsidiary, has been engaging in research. So normally, guys, in accounting, research is always what? Expenses, no? This could have been charged to what you can say, cost of sale. So we can start writing as potential reasons could be number 1, right? The research expense being charged to, right, cost of sales. That could be one reason. Yeah, there's a lot of research. Correct. Good. Okay. Right. So guys, remember, we are investing in 2 researchers, right? We are investing in 2 researchers. No, here they are telling it's being profitable. No, so we cannot tell that particular sentence. Okay, because they are telling it's going to be profitable, we are unable to use that point. Okay, guys, can you remember in this question, we have a intangible asset newly? Can you guys look at this part over here? Can you see? There is an intangible asset of 250 million. Guys, normally when there's an intangible asset, what can arise newly? amortization. No, there is an amortization now. So the amortization, guys, could have been charged to what you can say, guys, cost of sale. So we can write. Yeah, Shafee, that point we can again repeat again if we want, because we don't know exactly where they charged. No, that's a very potential reason. They could have charged this to here. Okay. So next one, guys, you can tell amortization, right? For the newly recognized, okay, for the newly recognized intangible asset. Intangible asset. Yeah, exactly. Intangible assets, guys, being charged to cost of sales. Okay. Apart from that one, guys, are there any other reasons that we can speak about when it comes to here? Right. I don't think so, guys. Those are the maximum amount of reasons that we can talk about. Okay, right. Then, guys, let's move on now to the operating profit faster. Okay. Let's move on to the operating profit, guys, quickly. Okay. Can you guys give me a quick comments about operating profit? So it has fallen. Now, guys, can you start writing for me the reasons on why it has fallen this way, guys, one by one quickly? Okay, please start writing the reasons on why it has fallen one by one. Yeah. Yes, very good, Asiya. Yeah, Shasha, that's correct. So, guys, I believe you can give up to 3 or 4 points on operating profit. Okay. Guys, I'll give you a small help. Try to use this information in the first paragraph. There is something over here also where you can talk about it. Okay, there is something over here also you can talk about it. That contingent consideration, the value keeps changing, no? You can, talk about that also. Right, okay, start writing the points, guys, for me over here. Yeah, we can, regarding that part, we cannot tell exactly because now they are telling in that paragraph that after sales service arrangement is profitable. No, so profitable means the revenue is much more than the cost. So therefore, better to not to use that part. Okay. Yeah. Can you guys write up to 4 or 5 points why the operating profit has fallen? Lot of points are over here only actually. Okay, right. Start marking these, will you? Right. Yeah, you can tell that, Daniel, that you can tell. Oh, let's see, guys, what are the other ones? Yes, Asya, you can tell that one. Yes, Amjad, you can add that point. Yeah, you can potentially tell that, but usually amortization, we normally take it to cost of sale. Okay, so better to avoid that part. No. The thing is this. Sleek cannot recognize the intangible asset. Only the room corporation only we can recognize. Only us only can recognize because for us it's purchase, no, for them it's internal. They can't recognize that. Okay. Right. Let's see, guys, any other points? Yeah. Guys, normally remember when you do the patent part, guys, it becomes an intangible asset. Okay, it does not what you can say affect the expenses section. Okay. Yes, that's Sajvi, you can tell that part. That is correct. More, you can use that point, no problem. No, we don't need to, okay. We don't need to go that far, right? Regarding the grant. Okay. Okay, right now, shall we then start commenting? Okay, now guys, we can start writing it this way. Okay, now guys, can you check your answers and see guys fast over here? And yeah, and also a student, yeah. Yeah, so guys, and we can, guys, I think most of you did mention this point earlier, but I never looked at it in that angle. Okay, it's just now clicking to me, right? Most of you did say about this part. In face of declining global sales, Room recently undertook the decision. A lot of you did mention this point, but I didn't see it in this particular angle. Guys, can you add this point on top fast a little bit over here, right? Right, decline in global sales, right? In global sales, because students sent it to me only, I'm checking on this one, right? Declining global sales, right? Could have, very good point, right? Could have reduced margins per product sold. Okay, margins per product sold. So guys, our revenue has gone up, not that no, but though the revenue has gone up, the margins that we are making is quite small. Now, sometimes guys, you can sell 100 products and still make less profits, no? Right? So because the declining global sales, maybe you reduced your price, sold more. So the sales is more, but not enough profit. The margins are less. Okay. Guys, now when it comes to operating profit, can you guys little bit check and see guys on the operating profit curve? Now I can give you these answers guys over here. So let's start number one, right? Right. Operating profit has reduced, right? This could be right due to, right? We can start writing. Okay. First point, decline in gross profit ratio, decline in gross profit. That's first point. Okay, right. Sleek has an operating loss, operating loss of 170 million. Because guys, in consolidated accounts, Sleek's performance is also there. No? Sleek already has an operating loss of 170 million, right? So he has an operating loss of 170 million. So we can add that point if needed, right? Sleek has an operating loss of 170 million. Right. Then guys, what are the other points that you can take, right? Then on the other hand, right? The business is engaging in, right? Engaging research projects, right? So I know that I explained research earlier because I'm not sure about the company policy, whether they're charging it to cost of sales or whether they're charging it to expenses. So when there is a research, when we charge it to expenses, our operating profit guys will definitely go down. Okay, right. That's one thing. What are the other things guys that we can mention over here? Right. Now this question guys, we are doing for 2003, you know. Okay, right. Yeah, and on the other hand, guys, you can, yeah, exactly, the contingent consideration part, you can also write over here, right? Right. But it should be noted that contingent consideration has declined over the year. Okay. Contingent consideration has declined over the year. Okay. Guys, now see, when I started the year, contingent consideration was 210 million. But when I'm ending the year, considering contingent consideration is how much? Only 160 million. So we have 50,000 gain. See, even with this gain, our operating profit has still fallen over the year. But on the other hand, guys, you should also remember now this Sleek company, tell me as it stands now, how are they doing? How does their future look? Do you think their future looks good or bad? What do you think guys over here? Right? Look at these projects that they are involving in. How does their future look good? Does it look good, guys, going forward, Sleek Corporation, the future? What do you think? Yes or no? It looks good. That means next year, this contingent consideration can go up in value. So then our expenses will increase. So then our next year operating profit might fall down even further. Now this year operating profit is good because contingent consideration, we have a gain of 50 million now. But since the company is doing well, it looks as if they might reach that target. If they do reach the target next year, our operating profit will fall even more than what it has. So that's something that we can comment on. Okay, yeah. So now guys, can you start marking over here, right? But since, right, the research projects has been successful, right? Right. And their self-driving project also looks promising, this could mean that the future of Sleek Corporation does look sound, meaning they will achieve the contingent consideration target which will result in our operating expenses going up further in the next year. Okay. So you can speak about that part. Contingent consideration going down means it's a good thing for us. Then we don't have to pay for these people, no, right? So it's like a gain for us. Yeah, the targets are not met. Exactly. I mean, yeah, kind of. Correct. So it's a good thing and a bad thing both. Okay, it's a good thing. It's a good thing because our expenses are going down. But then on the other hand, guys, it's a bad thing because we bought the company thinking that their future is good, no? Right? So it's a two-side thing. Right? Guys, next one. Let's move on to ROCE, guys. Let's move on to ROCE, right? Can you guys give a comment about ROCE, guys, quickly for me, right? Please give a comment about ROCE. It has fallen. Why it has fallen? Now, guys, can you start writing for me, guys, over here faster? Please start giving me points on why the ROCE has fallen. Okay, right. Start commenting about those, please. Yeah. So now state the state reasons on how the capital employed went up like that. Okay. Okay, so guys, let's check and see what are the points that you have given. Okay. Wait. Down. Yeah. Hmm. Okay, so we can't exactly tell that we took loans because the question does not get specifically tell. Maybe like generic points there we can give, but specifically it's not there. Yeah, Amjad's points are okay. Yeah, Shafee, that's good. Sazri's point is okay. Okay. Right. First of all, guys, can you tell me ROCE has fallen? What's the main reason, guys, behind the ROCE falling down? Because first of all, guys, what happened? Our operating profit has gone down. That's the main reason. So let's start marking, guys, over here ROCE, right? ROCE has reduced over the year. Right? Factors could be number one, decline in operating profit for the reasons mentioned above. Okay, decline in operating profit for the reasons mentioned above. So that's one. Okay. Then increase in capital employed. Right? Increasing in capital employed. As over the year, we have acquired Sleek. Therefore, Sleek's equity and liability has been added to the consolidated statements. Right? To the consolidated statements. Right? Because guys, capital employed means equity plus liability. No, so this liability, Sleek liability plus our liability both together. Equity, guys, we have Sleek's equity as post-acquisition reserves. Okay. And also, guys, on the other hand, we can tell the addition of NCI. Now, last year, we have only individual performance. No. But this year, if it's a consolidated performance, there is an NCI when compared to last year, which was not there. Okay. Addition of NCI. Okay. Non-controlling interest. Right. Right. Then, guys, you can tell recognition. Right. Recognition of brand name. There was a brand name, no, guys, if I'm not wrong. Yeah, recognition of intangible assets. Because, guys, when there is an intangible asset, assets are increasing, no, then the equity also, guys, will increase in that case. Okay. Intangible assets. Right. What are the other things, guys, that we can speak about over there? Recognition of intangible asset. That's one thing. So, guys, recognition of intangible assets means we can speak about this intangible asset and also this one, right? The development project, that's also intangible asset, no? Right? Yeah. And also, guys, over here, we can tell on the other hand, recognition of contingent consideration, right? Recognition of contingent consideration. Because like how a student said me in the chat box, it's a liability. So we have to pay. So then our debt capital is going up. Okay. Recognition of contingent consideration. Now. Okay. Yeah, what the section C pre-mock I recorded yesterday. So that recording should be available to you all soon, maybe like today, tomorrow. Okay. So I think hopefully by today. So then you can check on that. I did both the questions on that. It was a PNL and ratio. I'm not sure on that. Let me check and see. Okay. Right. So guys, any other points that we can give guys over here for ROCE by any chance? Any other points that we can give? It looks like guys, we have covered everything, no, for ROCE also. Yeah. Okay, now guys, last part. Shall we guys quickly? Yeah, that is then operating profit, no, because if you are in a research, our operating profit will go down, no, right? So that one we have mentioned over here, decline in operating profit. Okay, guys, last part, conclusion. Okay, right now guys, let's finish off with the last part over there, right? Conclusion. Okay, right. Conclusion. Okay, yes, can you tell me, purchasing Sleek, was it a bad idea? Yes or no? What do you think, guys? Okay, conclusion wise. Okay, what do you think, guys? Is it a bad idea that we have gone and bought Sleek Corporation? What do you think? Yes or no? As it stands, actually, guys, yeah, very good. Answer is no, because see, we anyway knew that, see, Sleek Corporation seems anyway they are a loss-making business. Here, guys, see, they are anyway making losses. So it seems to be a known fact that Sleek is a loss-making operation. But guys, did we ever buy Sleek for the profitability aspect? No, because we had a long-term plan. What's the long-term plan? There is a decline in global sales. So we are selling vehicles, it's declining gradually. So short-term, our business is not going to work. So the main reason why we bought that Sleek Corporation is because to invest in new technology, it made use of, right? There are new projects, what they are doing. To invest in that only, we actually bought them because actually their future projects are looking promising. Already one of their projects went into development. So meaning in the future, this is going to work. And also the self-driving one is already in research. It looks promising as well. So though in the short run, it may look as if Sleek is profitable, it's not a problem because we didn't buy them for short-term solutions. We bought them for long-term purposes only. So therefore, the acquisition of Sleek, as it stands, it looks good. Okay, so therefore, guys, let's write the conclusion over there, guys, over here, telling that, okay, right. Sleek Corporation, right, seems like a business, right, with a history, right, history for losses. That should not be an issue as Room Corporation never purchased Sleek with the intention of increasing profitability immediately. Right, immediately. Right. Its main purpose was due to the decline in global sales to shift to a new market in the future. Therefore, through the acquisition of Sleek, this can be done in the long term. Right. Already, one project has passed to development while the other is still in research. While the other is still in research. Right. As the projects do look promising, the long-term benefits can be derived. Okay. One minute, who sent me this answer, guys, over here? Wait, right. 1 minute. Yeah, 1 minute, guys. I'll zoom in the conclusion. Wait. Right, so guys, with this, let's start another one question. I believe there's another one question that we have to finish it off, right? I did the calculations, but not the discussion. Let's start the run, guys. Once you're done with this, I'll give you all 2 minutes. Okay, right. Guys, this is the other question that I started. Let's do it until 4 o'clock, and then I'll give you all the break, guys, after that one. Right. This question, guys, over here, right? Okay, this part. Okay, now guys, since we did this question a few weeks ago, what I'm going to do is, guys, from the marking scheme, now let me mark the answers first. Okay, because actually, guys, you all have already done this question. I believe we did this question on a Thursday class, not last Thursday, but the Thursday before that we did this. Okay, so therefore, guys, what I'll do, I'll first mark the answers from the marking scheme because we have already calculated everything, right? Question's name is, guys, Plundle Corporation 448. Okay, first of all, guys, potential gain or loss on disposal. Okay. Sure. Okay. Yeah. Let's okay, let me quickly mark these answers. First of all, guys, potential gain or loss. So in this question, if I can remember, we have a subsidiary called Holloway. Now, I think guys over here, we are P, right? We are Plundle, right? We own a business called Holloway. Now, we are planning to sell them. Not we have sold, we are planning to sell. So if we do plan to sell, what is the potential gain or loss? Okay, so we did calculate that one, guys. I'll just take the answer from the marking scheme. So it says that the potential, right? Potential gain or loss. They are telling guys the answer is 15 million, it seems. We got the answer. Right. Then guys, on the other hand, we also calculated ratios in the last class. Okay. So when I calculate the ratios, guys, it shows over here the answers are, it's this way, right? So we have a table. One is 2000x8. The other one is again 2000x8 according to the marking scheme. Right. This is guys 2000x8 restated. Right. This is 2000x8. This is the original. And over here, guys, we have 2000x7 also. Right. So, guys, GP margins, OP margins, and interest cover. Right. Our answers are, guys, going to be number one, 2008 restated. They are telling 41%, it seems. Right. 2008 original answer is 46.1%. 2007 answer is, guys, 47.6%. Okay, then guys, on the other hand, operating profit answer, right? Operating profit answer, guys, we are getting over there. Right. 9.9%. Okay. Whereas, guys, over here, it's going to be 20%. And then over here, the answers are 24.2%. Then, guys, interest cover ratio 1.7 times. 3.5 times. And guys, over here, the answer is going to be 3.8 times. These are the answers. Right. Okay. Right. Now, guys, shall we quickly evaluate this question also, guys? This is a question that has been pending for 2 weeks. Shall we quickly finish it off? Right. So, guys, now put the heading over the evaluation, please. Right. Please put the heading over there, guys. Evaluation. Right. Right. Done. So, guys, now they're asking like this over here. See, analyze the performance of Plundle Group for the year 31st of December 2008 and 2007. Your answer should specifically refer to the potential disposal of Holloway. So now, guys, I have answers like this. See, with Holloway, these are the answers in 2007 and 2008. Without Holloway, these are the answers. So if I sell Holloway, you should tell every single time whether selling this is good or not, whether they are contributing more or not. Like that, they're telling, here, see, guys, your answer should specifically refer to the potential disposal. Now, if we dispose, these are the numbers. If we have them, these are the numbers. So you have to, mention about these every single time. Okay, now guys, can you then start reading this question, guys, over here? What's going to happen quickly? So I will take away the screen for the time being, right? Let's start this one. Okay, so you can now guys start reading. So guys, what happened here? Plundle Group owns 100% of Holloway. They received an offer to sell Holloway for 121 million. So if we sell, we'll get 121 million cash. This is a 100% owned subsidiary. Okay, guys, now can you look at these points faster? Please go through them quickly. Okay, yeah. The thing is, Basil, the other one, I have taken it from here, from the question paper itself. Okay. We only calculated 2008 restated. So 2008 original answers and 2007 original answers question paper gave. That only I have copied it over there. Okay. That only I have marked it over there. Yeah. The other numbers, what I wrote are from the question paper itself. That's why. Okay, right. So guys, others, then can you go through that part then? So guys, point number 2 says, guys, we have recorded an impairment because one of our customers left the business organization, right? So therefore, guys, we have marked an impairment because the customer left. So take that point into account. So normally, guys, when customers are leaving and if there is an impairment loss, right? Normally, guys, which ratio will that affect, guys, when we are evaluating? Right, impairment losses, guys. Now we calculate 3 ratios: gross profit, operating profit, and interest cover. Which one, guys, will it affect over there? Right, gross profit, operating profit, interest cover. Which one will that affect? Customer impairment. Okay, customer has lost, right? So it will affect whom, guys? Impairment will normally affect operating expenses, because normally, guys, impairment we charge it to administration expenses. So that's something that you can speak about when it comes to your operating profit margin. Okay, guys, now when it comes to okay, third part, we are a business who develop games, but Holloway is someone who is specializing in material packaging. Okay, right. But the games have now, moved online. So the reason why we bought Holloway is to do our packaging, but now the problem is we don't need to do packaging anymore because the games are going online. Okay, so that maybe that's the reason why we are thinking of selling them. Okay, right. Next point. Plundle Corporation has experienced increasing competition in the recent years. This competition has led to, guys, increasing in competition. Which ratio will it affect? Competition is going up. Which ratio, guys, will it affect then? We have only 3 ratios: gross profit, operating profit, interest cover. Which ratio, guys, do you think it will affect us? That is 1. But before that, what's the main ratio what it will affect, guys, if there is any increase in competition? Gross profit. Because, guys, increase in competition means what? Our sales is going down, our margins are going down. So that will result in our GP going down. Right. How about the next one, guys? Increasing in research and expenses. Which one will it affect? Right. Research. We looked at it earlier also. Now, what are the 2 ratios? One is gross profit, because, guys, if there is a research, we can charge it to cost of sale. Or else, what is the other one, guys? Operating expenses. Correct. That also it can affect. Good. Okay, guys, let's go for the next page. Right, look at this part. Okay. Fifth point. Okay, look at the 5th point. For which ratio, guys, can we use this 5th point? Very good. Interest cover. Okay, we can use this for the interest cover. Now, interest cover, guys, you see, in 2007 and 2008, with Plundle, our answers are 3.8 and 3.5. Okay, without Plundle, what's the answer, guys? I got. Without Plundle, it's 1.7 times. Okay, so that means not without Plundle, my bad. Without Holloway, it's 1.7 times. So with Holloway, we were good. 3.5 and 3, because you know why, guys? Those people are trying to pay their interest over 10 years. Let me, guys, go back to the question paper, right? These people are, guys, paying interest over 10 years. That's their policy. Now, can you see here? Holloway uses much longer leases, whereas our leases are very short. Because our lease is very short, we have to bear high interest. So in 2007 and 2008, our answer is 3, which is good. That is because of Holloway. Now that the Holloway is sold, now what's going to happen? Our interest is very high. So we are unable to keep up with these payments. So actually having Holloway is a good thing, it seems, but let's evaluate further and see. All okay right now, guys? I have now discussed the question. Now, guys, can you start writing the points now fast, one by one? Start with gross profit ratio, guys, quickly. Okay, put the heading performance and start with that, please. Guys, if you want, you can calculate individual ratios for Holloway if needed. If you have enough time in your exam, now see, guys, Holloway's revenue, Holloway's gross profit is given. So you can calculate his own gross profit. I mean, no need to calculate, but just see what is the answer, guys, we are getting for that one. 18,080 divided by 33,500. That is 53%, right? His gross profit ratio is 53% alone, right? So these are some points what you can use, okay? Right. Because now see, guys, 46.1% and 47.6% is the group. No, group means what? Holloway and Plundle both together. But Holloway alone is making 53% gross profit margin. That means, guys, who is the person who is bringing this company down? Is it Holloway or Plundle? Plundle is the one who is bringing the performance down. See, guys, look at this video. In 2008, both together 46.1%. Holloway alone, I calculated the gross profit ratio. You can calculate, right? It's 53%. So Holloway alone has a more margin than the group itself. So the one who is not performing well is Plundle and not Holloway. Because of Holloway only, it is at least 46.1%. Like that, you can start doing. So if you want to make your answer much better, you can calculate individual ratios for Holloway even, so that you can show he is important and not to sell him. Okay. Right. Okay. Continue, guys, with your work then. Right. Continue with your work. Right. So, guys, I believe this is the third consolidated question we are doing. Okay. Individual ratios, I think we have done quite a few, around 3, I guess. And in the pre-mock, I did another one. So that's 4. Individual ones, not a big deal. Consolidated one only, we have to focus more on. Okay. So his one, guys, alone gross profit is 53%. How much is his operating profit? His operating profit alone 13,580 divided by 33,500. It's 40%, guys. This person's operating profit alone 40%. Okay. Try it now. We have done 336 now with the pre-mock 7 now. Try to do another three more. Okay. Try to reach 10 before the exam should be fine. Okay. And guys, interest cover 13,580 divided by 1,900. He alone can pay 7.147 times. Okay. These are the individual ratios of Holloway for 2008. Huh? No, this is the third one. No, what we are doing. Okay, this is the third one. Because I remember there was a question that active division something. Okay, but anyway, after the break, we can touch another one also. Okay, if possible. Yeah. So this second concept, but we need one cooperation also, no, in your list. I think that's not there. Okay, right. So guys, I hope you're starting to evaluate the question. Let me also guys mark the points one by one quickly, whatever that you're writing. Okay, right. Okay, so guys, we can now start marking the point number 1. And okay, let's start guys over here. Now, first thing we can tell, right? Right. After the disposal, right? Okay, first of all, guys, we can tell like this, right? Okay. Over the year, the gross profit has fallen, right? The reasons could be, right? The reasons could be, right? Number 1, fall in revenue could be, okay, right? Fall in revenue due to heavy competition, okay, due to heavy competition, right? Due to heavy competition, right? Right. Yeah. Another batch over, another cake. No, the second time I think I'm getting. I think you all gave one when you're doing MA also, no? Yeah. I'll take this one. We have tissue. Oh, it's okay. I think there's something I can keep it here. No problem. Right. Thank you. Okay. Right. So So guys, fall in revenue due to heavy competition. That's one thing what we can say over there. Right. Second thing, right? We can also say, right, the business engaging, right, in research projects, in research projects. That is one thing, right? Okay. Right. But then, guys, you have to also point wherever possible how important is Holloway. But then on the other hand, guys, you can tell, right? Right. With the disposal of Holloway, right? The gross profit is down even further at 41%, right? And with close inspection, right? Holloway alone, right? Holloway alone generates 53% of gross profit margin. Guys, like I said you, I individually calculated the ratio for Holloway, right? Holloway alone, how they are performing. So it's 53%, right? Which reflects that their packaging business, right? Their packaging business is doing quite well, right? Their packaging business is doing quite well. And it's Holloway who has been contributing, right? Contributing much to the group performance. Okay. Much to the group performance. Which is a reason, right? Which is a reason on why, which is a reason on why Holloway should not be disposed, right? Which is a reason why on Holloway should not be disposed. Right. So guys, any doubts if you're having on my points, you can ask me. Right. Then guys, next one, let me move on to the operating profit part, guys. Operating profit, right? Okay, right. Operating profit, right, has declined from 2000X7 to 2000X8, right? And it's now gone down by almost 50% with the removal of Holloway. Okay. So why do I say that, guys? Now you can notice this. Now look at this one, will you? Here it's 20%. Now from 24, it became 20. So we have facing heavy competitions. Maybe we don't have proper control on our expenses, right? So it has dropped. But if I remove Holloway, 20 becomes now 10. 10% we are losing because we are removing Holloway. And guys, see, Holloway alone is generating a gross operating profit margin of 40%. So he seems to be doing good alone. Okay. He has good control of expenses. And even, guys, remember there's an impairment. One of his major customers went bankrupt. Even with that impairment, still he is getting 40% alone. So these are points that you can, speak on. Okay. So let's start marking, guys, over there, right? Has declined 50% with the removal of Holloway, right? Which suggests that, right? Right? The business has a poor control, right, on expenses, right? There is also an impairment during the current year, right? There is also an impairment during the current year. What are the other things, guys, that we can mention over here, right? Is there anything else that we can tell? Right. Right. But Holloway alone generates an operating profit of 40%, even with a customer, even with a major customer being bankrupt. Right. So guys, since this is a major customer, we have to little bit take that into consideration because it's a major customer. No? Next year, what's going to happen to Holloway's revenue is now a little questionable, right? Right. So Holloway also generated even with a major customer being bankrupt, right? But the bankruptcy, right, should be taken into account as to what will happen to Holloway's revenue in the next year. Okay, as to what it will happen in the next year. Right. But then we can also add Holloway seems to have a better control of expenses when compared to Plunder. Have a better control of expenses. Holloway seems to have a better control of expenses. Okay, right. Okay, now guys, why do I say that particular point that this person has a better control of expenses? Guys, now see, when I calculated this person individually 53%, but operating profit is 40%. That means they are losing only how much percent? 13%, no? But whereas guys over here, can you see us as a group, we have lost 26%. Okay. See guys, our GP is 46, but OP is 20. We are losing 26% as a whole. But Holloway alone has only lost 13%. So his control of expenses is much better than ours. So it is his contribution, who is keeping things like well for the group. So therefore, guys, you can write over here, right? This is, right, another point, right? Another point on not, right, on not to sell Holloway. Not to sell Holloway. Okay, then guys, last part, let's quickly now discuss about the interest coverage ratio, guys, faster. Okay, let's talk about that interest coverage, right? Okay. Right. The interest coverage ratio, right, with the removal, right, of Holloway is only 1.7 times. Okay, is only 1.7 times, which shows, right, that Plundle alone shows that, okay, right, Plundle alone is unable to make interest payments with the available profit. 1.7 is not good, okay, with the available profit due to, right, their leasing policy. right? Leasing policy, right? Holloway alone can pay interest, right? 7 times, right? Holloway alone can pay interest 7 times as their lease is spread over 10 years, which gives a lower finance cost. Now, in this case, like to be very honest, there is no benchmark, but taking the context into situation. Earlier we were 3, now we are 1. So we have fallen down twice. Holloway alone can pay 7 times. We alone can only pay 1. So relatively, when you take the context, we are at a very lower level. Okay, right? Lower finance cost, right? Okay, this is another reason, right, to keep Holloway, right? Then, guys, last part, we can now give the conclusion, right? Right. From the above, it could be noted that Holloway is a major contributor. It's a major contributor to Plundle Group's performance, right? With the decline in revenue for Plundle, in their industry, and sound performance of Holloway it would be ideal to hold Holloway rather than disposing. As the organization does not need, okay, as the organization is not in a need regarding cash flows. Okay, right. So guys, what is the meaning of that sentence what I have written there? Now guys, see now see, in every aspect of the performance, Holloway is good. You understand? Right? Now, the only reason why forced to sell that company would be to get that money. Now, when you sell Holloway, you're going to get some money. No? So the question says we are going to get 112 million cash using that. So the only reason that it makes sense to sell Holloway is to get that 112 million cash. But in the entire question, guys, when I go through the question, does it say that Plundle needs cash? Like easy having like an overdraft situation or something like that? No. So it doesn't seem like the business is in need of cash. So it doesn't make sense to sell Holloway, right? Because it's an organization who has been contributing well towards the performance. So the conclusion is not to sell unless you are in a need of cash. Right? Okay, copy and finish it off, guys, faster. Okay, so guys, now once we are done this part, guys, over there, you all can now, guys, take your half an hour break, right? And guys, can you come back at 4:30? Now the one question we will do on consolidated ratios. Okay. Right. Okay. Have your break and guys come back then. Sugar, that's great. No, I think that was enough. No, 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 say, say. Thank you. Thank you. Huh? I'll be getting sugar at this rate. Okay, right. So guys, let's continue after the break. Let's do one more ratio question consolidation. We'll calculate, let's discuss, then you can write the points down later even. Okay, let's do a discussion quickly, right? Right, last question, guys, on consolidation. Okay. Guys, can you all go to this question, guys, over here, the one before room? Okay, right. Question name 446 Marvel Corporation. Go to that part, guys, over there. Right. Okay. Please go to, guys, the above question that says Marvel Corporation. Right. Go to that one. Okay. Right. Shall we start, guys, quickly then? Okay. Look at the question then. Right. On 31st of December, Marvel owned a number of subsidiaries, including a 100% equity share in someone called Bilston. Extract from the draft summarized financial statements for Marvel Group is given below. Okay, so they have given, guys, remember 2007 and 2006, both of these are, guys, what? Consolidated profit and losses. Okay, both of these are, guys, what? Consolidated P&L. Okay, then what they are telling? Okay, then there is a consolidated SOFP also, right? On 30th of June 2007, guys, now take this point into consideration. Our question is going for December 2007 and 6. On 30th of June, Marvel sold all the shares in Bilston for 22 million. Okay, so when you sell a subsidiary, we call it as what, guys? Group disposal. But when is it happening? It's happening in June. This year, after how many months? Very good. After 6 months, we are selling the subsidiary. So take that into consideration. Okay. So guys, in this paper, what they are telling, A part, calculate the profit or loss on disposal in Bilston Corporation. So it's a group disposal. They are asking you to calculate gain or loss on disposal. Shall we start the calculations, guys, quickly? And then we'll discuss the points fast. All good. Then you don't need to write everything. You just listen to, you give your points and I will give my points like that. Let's have a quick discussion faster. Oh, no, we just started off. Okay. The previous question called Bilston 446 we are doing. Okay. Okay, right. Now, guys, can you start now marking this with me now, guys, quickly? Okay, so put the heading. What are they asking you guys to do? They are asking you to do group disposal. Can you guys write the equation faster? Right. Requirement A, group disposal. Right. So, guys, for group disposal, how do we calculate? What's the equation? First, we need sales proceeds minus net assets at disposal, goodwill at disposal. Okay, goodwill at disposal, and minus NCI at disposal. Right? This is, guys, remember, this is a 100% owned business. Huh? This is a 100% owned business. Okay, guys, now can you look at this paragraph and get me the answer, guys, faster for group disposal? Right? Please try to calculate for me the group disposal answer. Okay, let's start on that one, please. So guys, only by looking at the paragraph, can you get me, guys, the answer for group disposal? I'll give you around, guys, 5 minutes to 10 minutes. Okay, let's start on that one, guys, and quickly. Which one? No, that no need to do. That we don't have to do it that way. You can just take it as it is. One minute, Amjad. No, smaller. A little bit. Can you just check and see one more time? The profit, no? Yeah, that's the correct answer, Shahna. That should be the correct answer. Good. Yeah, that's correct, Sazri. Now, Amjad, now your answer is correct. Good. Yeah, good. Sahlau's answer is correct. Sahlau's answer is correct. Okay, guys. Now others who are doing the question can little bit check and see it because now some people have finished. I'll discuss. Sales proceeds. Guys, we are selling this company for 22 million. So let me mark that here. 22 million. NA, guys, what is NA? Net assets at the disposal date. Guys, we are selling on June. No? That time the net assets are this much. 20, 23.2, 23.2 minus 5. How much, guys? 23.2. Okay, so therefore, guys, it's going to become how much? 18.2 million, right? That is the net assets at the disposal date, 18.2 million. Then, guys, goodwill at disposal. Guys, listen, in this question, first of all, the goodwill is not provided. Okay, so you have to calculate, right? So first of all, what you should do, guys, you have to calculate here goodwill at acquisition. Now, normally, how do we calculate goodwill? First, we need investment. What is investment here? 25 million. We are paying 25 million to buy the company. All good, right? Then after investment, guys, we should add fair value of NCI. Do we have an NCI in this question? Answer is no, because we bought 100% of this company. So therefore, guys, there is no NCI. Minus net assets at what date? Acquisition date. Here, guys, can you see net assets at the acquisition date? 2,300. Sorry, 23 million, right? So therefore, guys, now based on this, okay, now based on this one, 2 million will become the goodwill, but that's the goodwill at the acquisition date. We can't take goodwill at the acquisition date. No, I want dispose goodwill at what date? Disposal date. Then what should we do? From goodwill at acquisition, you have to subtract impairment. Then you will understand what's the goodwill at the disposal date. The paper says goodwill has been impaired by 25%. Okay, so guys, now when I check for impairment of 25%, what will be the answer in that case? 0.5 million. Therefore, the goodwill at the disposal date is 1.5 million. Mark it, guys, over here. Right now, guys, at these two, then you will be getting 19,700. There is no NCI in this question because it's a 100% owned subsidiary. So therefore, guys, based on this one, we are getting a 2.3 million profit on disposal. And the paper says this gain has been included in administration expenses, right? They have set off the gain to administration expenses. Right. Can you guys copy this down faster? Let me know for any doubts that you have on the calculation. Okay, so guys, are we now all okay with the goodwill at disposal? Okay, no? Okay, now, so guys, we got a profit, huh? Right. And also remember, we got some cash also. That's important for the calculation. We got some money and we got a profit also. Okay. Right. Now, guys, what they are telling here, the group has recently encountered difficulties in trading, which led to the decision of disposal of Bilston. The results of Bilston were included in Marvel Group's consolidated profit and loss for 6 months. Right? Now, in that paragraph, what they're trying to tell you is this. Guys, now see. In 2006, consolidated P&L, Marvel plus Bilston. 100% performance is inside this. But in 2007, Marvel's 100% performance is there. Bilston's only 6-month performance is there. Because after 6 months, we sold the subsidiary, guys. So only 6 months income and expenses of Bilston is inside this profit and loss account. That's one thing that you should learn. Second thing, guys, what you should know is in the statement of financial position in 2006, it's both Marvel plus Bilston. But in 2007, it's only Marvel's numbers that you see there. Because you're preparing SOFP on the last day, no? On the last day was Bilston with you? No. So these numbers in 2007 SOFP are only whose numbers? Marvel's numbers. No Bilston numbers are inside this. Okay. Then guys, on the other hand, now what they're asking you to do, calculate the ratios for the group 2007 and 2006. Now guys, shall we quickly start calculating? After that, points, no need to write. We'll only discuss and we'll finish off the class with that. Okay, right. So guys, they're asking now gross profit, operating profit, return on capital employed, and also guys, net asset turnover for you to start calculating. Right. Now guys, let's start calculating it together then. Okay, so I'll give you the data. Right. So they're asking guys from you 4 ratios. Okay, can you guys quickly set up the 4 ratios faster? Okay, set up the 4 ratios quickly. So guys, they're asking for 2007 and 2006 both. Okay, so let me then draw the table. So they are also asking us net asset turnover. Net asset turnover means guys normally revenue divided by capital employed. These 2007. Okay. And then guys, these 2006. Right. Now, guys, first of all, from here, whatever the numbers that you want, can you guys copy it? Now, guys, I can't. Now, SOFP is in one page, income statement is in one page. So, therefore, guys, first from here, can you copy, guys, whatever the numbers that you need? First copy from there. Okay. Whatever the numbers that you need, first copy it from here to there, guys, faster. I'll give you a few minutes time. So guys, from this page, have you copied down whatever that you need? Shall I guys mark now? Okay, 2007 gross profit 60,000, 2008 gross profit 80,000. Right. Next one, guys, down revenue. Right. So the revenue, guys, 275,000 for this one. Okay. Right. Into 100. Whereas, guys, over here, it's going to be 80,000 divided by 375,000 into 100. Okay. Right. Then, guys, on the other hand, operating profit, guys, just copy the numbers, what they have given directly, 23,500 over here. Divided by revenue, 275,000 into 100. Over here, guys, we have profit from operations, 43,000. Right. That divided by 375,000 into 100. Again, guys, operating profit, 23,500. Here, guys, 43,000 divided by capital employed. Here, the revenue, I can write 60,000 and the revenue, guys, 80,000. Now, the only thing, guys, what I need is now capital employed. So, capital employed, guys, we normally find from the next page. Okay. So, guys, quick recap. What is capital employed? Capital employed is, guys, the equity plus what? The non-current liabilities. This is what we call, guys, capital employed. Okay. Capital employed means what, guys? The equity, right? So in our case, the equity is 226,238 and the non-current liabilities. Okay. Now, guys, start marking that one over there. So 226,000 plus 15,000, 241,000, I believe the answer. Here, guys, 238,000 plus 140,000 will give me 378,000. Okay, 378,000 into 100. It's included inside equity, correct. not current liability. Okay. Over here also, guys, 241,000 into 100. Here, guys, we have 378,000 into 100. Right. Now, guys, can you quickly copy and calculate these ratios, guys, faster? Disposal profit 2,300. Okay, disposal profit is 2,300. For that working, I did it over here. Okay. Right. Guys, can little bit check and see, guys, ratio answers, but these are okay, guys. Faster, let me quickly mark them. So first one, guys, gross profit, it shows 8.5%. Okay. Whereas, guys, over here we have the other one, 21.3%. Right. Then, guys, this one over here, the operating profit. Sorry, guys, gross profit is, I think, 21.8%. No? Yeah. Right. 21.8 and 21.3. 1 minute. Revenue, no? Yeah, the revenue is not, these not the revenue, no? This is the gross profit. Thank you, Shima. Has to be 275,000, and over here, guys, revenue has to be 375,000. Okay. Right. Then, guys, over here, according to a student, 8.5%. Okay. And, guys, the other one, 11.5%. Okay. Right. Then, guys, over here, 9.8%. And, guys, over here, it's 11.4%. Okay. Right. Then, guys, last one, net asset turnover. Over here, guys, there's a small change, 1.14 times. Whereas, guys, over here, right, 0.99%. So 0.99 times. Okay. Right, guys, these are the answers for the ratios. Okay, these are the answers for the ratios. Okay, right. Right now, guys, we don't need to write the points. We'll just have a discussion, and then you can later look at the marking scheme and also take the points. No, okay. So let's just have a discussion quickly on what are things that we can write and how you're going to evaluate these questions. Okay, can you guys quickly copy down the answers for ratios, guys, faster? Copy down the answers, please. Okay, all good, guys. Shall we start then? Right, we'll start evaluating quickly. Right, guys, now see, first of all, can you guys quickly give me a comment about the profit and loss? All the numbers have reduced. What is the main reason, guys, behind this one? Okay, right, 2006 to 2007, guys, all the numbers, see, revenue, cost of sale, gross profit, profit, everything has reduced over the year. What is the main reason, guys, behind this? Why has it dropped? Exactly, because of the disposal of the subsidiary. Guys, in 2006, the answers are what and what? Marvel and Beano, both together. But in 2007, guys, these numbers are only what 6-month performance of bill. So therefore, because 6-month performance of B is there and 6 month is not there, obviously, all the answers when compared to last year are going to be less, right? Simply because now even guys in SOFPO, same story. Now guys, can you see here? Property is less, non-controlling interest is less, loans are less. Overall, the numbers have declined from 2006 simply because we have disposed a subsidiary. That's why it is less. Right. Now, guys, shall we comment about the gross profit ratio? Now, guys, look at this. Even though the revenue has fallen, now you can see, guys, right? 375 revenue became 275. 80 gross profit became 60. But our gross profit has slightly improved. Right? Even with the figures being down, gross profit has slightly improved. Okay, guys, now I'll tell you a small thing. Can you read this last paragraph over here and tell me what's the reason behind it? Okay. Read this last paragraph and guys tell me what's the reason behind this one. Why has our gross profit ratio improved, guys, when compared to last year? Right, what should be the reason? Right, our numbers have significantly gone down, but still our ratio has slightly improved. What is the main reason? What do you think, guys? Online people, what could be the main reason, guys, why we have why it has improved? Right. Now, guys, in that paragraph, what they are telling, right? The group has recently encountered difficulties in trading, which led to the decision of disposing Bilston. Now, guys, can you see? Without Bilston, our gross profit ratio has actually improved. It means that, right, what is our company name? Marvel. We are actually doing good. Right now, this was not the case in the previous question. Previous question, we were doing bad, subsidiary was doing good. But here, guys, over here, what's going to happen? It shows that the company is having trading difficulties. And we sold. So it seems like Bilston was not contributing much towards the gross profit. See, even without him, we are doing better. So even without him, guys, our company called Marvel, and also we have some more subsidiaries, we are performing well. So that's the reason, guys, why our gross profit ratio has gone up. You can tell that way. Right. Now, guys, can you talk about the operating profit part, guys, over here? Now, can you tell me, guys, now our operating profit, guys, has actually declined. Okay, 1 minute. Exactly. Most of our gross profit has been made by other people. Yeah, it does include 6-month performance, but without the rest of 6 months, we have been doing better. What you said is true. Okay, right. Guys, next part, guys. Our operating profit, guys, from 11.5% is now only 8.5%. It has gone down. So one reason why the operating profit is going down is because one thing, our revenue has fallen. Can you guys tell me any other specifics on why it has fallen? There's another one reason from here. Why our operating profit has, guys, fallen. 2 reasons actually, right? From what you read in this paragraph. Can you guys check and let me know faster? 2 reasons why our operating profit is. Now, guys, I'll just take this off for the time being. Okay. Now focus on this question and tell me 2 reasons why our operating profit margin is lower. 1, revenue has fallen. 2 other reasons, can you tell me by looking at this part? Exactly. There was an impairment of 25%, no? Right. So because there's an impairment that would have affected our operating profit. Guys, not only that one, you should also note that our operating profit has a one-off item. Can you guess me what is that one-off item that we have inside the operating profit during this year? Very good. That's the answer. How about the others, guys? There's a one-off item that's inside our operating expenses. What is that? Exactly. The profit on disposal. Here, guys, we made a profit on disposal of how much? 2.3 million. No, that's inside administration expenses. So that has to be taken into consideration, right? Operating expenses, operating profit has fallen even with that profit. Now, next year, we are not going to have this profit. So meaning the operating profit can be a little lower. Very good. So that's one. Right. Then, guys, there's another one thing I want you to focus and tell me over here. This part. Guys, look at this one a little bit. Guys, see, Marvel Group, do they have only one subsidiary? No, they have many subsidiaries. How do I know that? Here, guys, are telling over here. See, Marvel is a business organization who has number of subsidiaries. Guys, now look at this. When I started the question, my goodwill is how much? 8 million. But I'm finishing the question, my goodwill is 0. That means, guys, what happened to the goodwill completely? The goodwill has been completely impaired. Okay, see, starting goodwill is 8 million, no, guys, but now finishing goodwill is 0. Goodwill has been completely impaired. Okay, so 8 million impairment, but guys, you should understand from this 8 million impairment, 500,000 is related to Bilston. You calculated now 500,000. The remaining impairment is relating to other subsidiaries. So because of this big impairment, our operating profit has taken a big hit. Okay, it has gone down by 3% when compared to last year. So that's what we can talk about, guys, operating expenses, right? Then, guys, let's move on to the next ratio. Guys, ROCE 11.4 became 9.8. Can you guys tell me directly one reason why the ROCE fell? Because first, what happened? Exactly, the operating profit fell. Because the operating profit has fallen, our ROCE also has fallen. But then, guys, on the other hand, can you look at this part, guys, over here? Right. Capital employed. 378,000 worth of capital employed now only has become how much? 241,000. Capital employed has dropped. Guys, technically, when capital employed is reducing, what should happen to ROCE? It should increase. No, it should increase. But still, our ROCE has fallen down. Why? Because our operating profits are not good enough. Right? Our operating profits are low. Because of that, our ratio has not improved. Guys, can you tell me some reasons on why ROCE, guys, fell down in the first place? Can you give me some reasons? Right? Our return on capital employed is less. Our capital employed is less. Can you guys look at this SOFP and tell me why is our capital employed has reduced over the year, guys, faster? Can you check and let me know? What is the main reason why capital employed reduced? Because of disposal, no? Because when you dispose, right, subsidiaries equity, the Bilston's equity is not there, no? So that is why ROCE has fallen. Not only Bilston equity, can you guys look at this? Bilston's loans, right? With Bilston, the loan is how much? 140,000. Without Bilston, what's the loan? 15,000. So there's a big drop in loans, right? This big drop in loans can be described in two ways. One, we sold Bilston and got some money. No, from that money, we could have settled the loans. Or maybe all these loans are Bilston's loans. Once we remove Bilston, that loan no need to show. No. So because of that drop, our capital employed has reduced tremendously because we sold Bilston. But still, we are unable to improve our ROCE because our operating profits are quite low, right? So that reason, but we can take. Right, then guys, let's move on to the next ratio, guys, what we have, right? Net asset turnover. 0.99 net asset turnover became 1.14. That means, guys, it has gone up. Is it a good thing or a bad thing? Net asset turnover, guys, going up. Is it good or bad? It's good. That means we are efficient. But can you look at these numbers and tell me now? Usually, guys, when the net asset turnover increases, it means that we are efficient. But can you look at these two numbers and tell me, are we actually efficient? 1 minute, guys. Okay. Can you look at these two and tell me the two numbers? Look at the top denominator and the numerator and tell me, are we actually efficient? What do you think, guys? See, our revenue has fallen. Technically, when the revenue falls, net asset turnover should improve. Sorry, it should go down, no? But it has improved. What's the reason? Why has our net asset turnover actually improved? Because the capital employed has gone down because we sold the subsidiary. So it's not actually an improvement. Okay. Not actually we are efficient because capital employed has gone down because we sold the subsidiary, we settled the loans and all of those. So it's not actually we are not efficient. It's just that because we sold the subsidiary, it has improved our ratios. So we can tell that. Right. Anything else, guys, that we can speak on this question? Let's check and see. This one, everything taken care of. And guys, then you can, add points like now finance cost has fallen down. Okay, now see, guys, distribution, administration cost has increased because of impairment, but distribution cost has gone down. So maybe our cost control is good. Finance cost has gone down. Guys, why finance cost fell down? Because we settled the. Normally, why does interest fall down, guys? Because we have gone and settled what? The loans. The loan has dropped now, guys. Here, can you see? 140,000 loan became 15,000. Tremendous change. Because of that, we are now saving up on our finance cost. Right. Then guys, when I go to the next part, PPE has reduced because we sold the subsidiary. Goodwill has gone down. Impairment, we already discussed about it. Retained earnings have gone down. Guys, look at this. We are making a profit, but still retained earnings has gone down. What's the reason behind it? Right? We made a profit, but still retained earning has gone down. Guys, normally why does retained earning goes down? Because we have paid what? Dividends. The organization has paid a good amount of, guys, now see, 18 million retained earning, 9 million profit means it's 27 million, no? Can you see? Our retained earning starting is 18 million and then 9 million means it has to be 27 million. But it's only 12 million. That means a big amount of dividends we have paid. That has to be questioned. Right? We have paid a huge amount of dividends during the year. Right. Then guys, our loans have reduced. That's because we have settled the loans using the money that we have got. So overall conclusion, guys, we can tell it like this. Right? As the organization is having trading difficulties and maybe because Bilston is not performing as well as we have expected, right? We have sold off that subsidiary. Most of the ratios have improved. Some simply because the ratios, right? I mean, now you saw, no, guys, net asset turnover and all, not that we are doing well, but it's just that mathematically it has improved. So we can come to a conclusion, okay, selling Bilston was a good thing because financial performance, it has improved. Guys, one more thing you should tell, one thing. Now see, now when you can add it as an additional point. Guys, can you tell me, in profit and loss account 2007, we are having whose and whose information? Marvel and Bilston, how many months? 6 months. But when you take 2007 SOFP, we are only having whose information? Only Marvel. So sometimes when calculating ratios, it does not give the exact picture because this is Bilston plus Marvel, no? But assets are only whose? Marvel. So when you calculate ratios from that and this, when you calculate, for an example, ROCE, net asset turnover, see guys, now see, now when you take ROCE, what I'm trying to explain is this. In ROCE, operating profit and this revenue you're taking from an income statement, no? That is Marvel's full year performance, Bilston 6 months performance. But capital employed is only Marvel's capital employed. So when you're calculating the ratios, it doesn't show the exact figure, distorted figures we say. So that is something that you can mention when you do your evaluation. So this is how, guys, you need to evaluate this question. Just check the marking scheme also, and then you can mark your answer. But I have discussed on how you are going to do. Okay, right. So guys, then with that, then I will be then concluding, guys, today's class. And most probably, guys, if I'm not wrong, this should be the, because you know why? The capital employed is only showing the year-end answer, no? Okay. Revenue is Marvel's full year performance and Bilston's 6 month performance. But capital employed is only Marvel because that's at the end of the year. So you're dividing by like 1.5 year performance with 1 year performance, like that. Okay, right. So guys, then with that, then we will be then wrapping up FR sessions, right? This is the final class, guys, that we have before the exam. So I wish you guys all the best for the exams. The pre-mock recording should be available today, tomorrow. I'll just have a chat with the office before I go. Please go through that part, guys, over there. Make sure you complete the full paper. There's another ratio question there I am discussing, but that's single entity. Okay. Right. All right, guys. So that's it then. Okay. All right, guys. Welcome then. Let me know how the exam went. Okay. Once you're done. All right, guys. Welcome. Okay, sure. I'll just check on that. Okay. So I haven't gone back to WhatsApp for a very, very long time. There are some doubts like 1 week also. I have to check on them. Daniel, you can drop a message. I will be checking again WhatsApp on Monday. Okay.
A few doubts in areas like dividends given by subsidiary.
Okay, when dividend is given by subsidiary is marking in SOCE, that we don't have to worry about. But in our income statement, parent will mark under other income. No? So we should remove only our share. That means, let's say subsidiary paid a dividend of 10 million.
Like the question, it was said paid 1 million.
Is it our share?
Yeah, like
That's a total dividend
Total,
paid. So you have to calculate our share and remove from other income.
fully, our share should be fully removed.
Fully removed because it's an intra-group transaction. Because for subsidiary, we are showing the profit that we are earning now. Again, the dividends we can't show.
Okay. There has more like a confusion in the fair value of NCA and the fair value adjustment in the working group.
Okay. Right.
And the deferred consideration, how to calculate.
How to calculate that? That will go like this. Okay, wait. I'll show you that. But can you just give me 2 minutes? If you can stay online, I will show you how to do that. Okay. Right. So it's like this. Fair value of NCI, you have to calculate like this. First, you should take the percentage of NCI, multiply this by the number of shares in subsidiary company.
The total share.
Total share.
Okay.
And that you should multiply by market value of subsidiary share. Now, normally in the paper, they'll give two market values, parent market value and subsidiary market value. You have to only calculate subsidiary market value only.
So this goes under the
Goodwill working and also NCI working. Right. Okay. Right. Then on the other hand, you said fair value adjustment. No. Yeah. Right. Fair value adjustment, what you should do, fair value adjustments of property.
Yeah.
Right. Then what you should do is like this. In working number 2, you should copy it to acquisition column first. Because it's happening on that date. Normally, we mark the same answer to the reporting date also. But if the paper says the value has changed, you should then mark the new value at the reporting date.
Like when we do a disposal.
Kind of. Now, let's say for an example, when you're starting the year, fair value increased by 10. But then only 8,000 of the property is only remaining. Then only 8,000 you should mark in SOFP and show. But if the value does not change, if it's still 10,000, 10,000 should be added to our PP.
No, what's the difference in this fair value and the previous adjustment? Like this is the adjustment, right? Which comes under working too.
Working too.
And what's the adjustment of fair value, real fair value of NCA? What's the difference?
No. These are not connected. This is market value of property.
Property fair.
Property market value. This is the market value of the non-controlling interest. Two different things. No connection. Right. Last one, we have deferred consideration. So deferred consideration, step 1, what you should do, you should find the present value.
Okay.
That is future value, multiply the discounting factor. Then what you should do, this one, investment account should be debited. You have to add to the SOFP investment. Most of the time, what happens is in the exam, they don't mark the deferred consideration.
Okay.
So what you should do, once you find the present value, you add to the investment in the SOFP.
Okay.
And also the same answer, you should mark it as a non-current liability also. Most of the time non-current, but sometimes it can become a current liability depending on the question. That's it. After that, what you should do, this present value, you take and put the percentage. This is the unbinding of discount. This one, you add to your non-current liability answer and take it under retained earnings as an expense.
Retained earnings as an expense.
So retained earning debit, non-current liability credit.
So later when we take to the investment of Goodwill,
that time you should only take the present value.
Present.
Not the added answer.
Like the investment debited.
Only that only should take. Okay, right. Right. Amjad, your pre-mock exam, you will be able to get it this way. First you type pre-mock. That's it, bro. Welcome. Okay, so once you log in, just type pre-mock exam. So once you type pre-mock exam from the ACC website, it will show like step 1, complete the new mock. Just click on the first part, access the pre-mock. So once you do that part, it will take you to a page like this. Search financial reporting. Okay. Then you have ACCA official resources. Click on that and click on practice exams. And you have over here pre-mock. You can start using this one. That's how you do it. Okay. Done, no? Right. Super. Right. All right, guys, welcome then. I'll ask him to upload it. Okay. Are they only for section C? You don't have section A available or B even. Only C. C also, like 2 sessions, they give only one question each now. Usually 2 sessions means there has to be 4 section C questions. No. Nowadays exam, they only make 2 available out of 4. That's how they do it. Okay.